Hello traders. In this video I look at how the markets are setting up ahead of what could be a very critical 2 weeks in dictating how markets trade over the coming months, and how I'm also seeing a great deal of risk to current market expectations, as well as the trading themes that could be immensely profitable should those risks materialize. JOLTS, ADP, ISM services, then NFP, followed by inflation reports the week after. These are some very critical data points that could dictate Fed policy and greatly influence, if not change, market expectations for the next 3 or even 6 months potentially. First, let's take a quick look at how the market action has been setting up as we start the new month. Since April, we've seen risk assets having a strong 4-month stretch, particularly the US, where the Russell Small Caps was the strongest performer of all the indices listed here, which is quite typical that you see small caps perform strongly when rate cuts are anticipated. Also, parts of the Asian equity markets have seen some strong monthly performances too, which appear to have benefited from global fund managers looking to diversify away from the US and finding some cheap valuations. For example, South Korea is one market that's seen a lot of foreign inflows and a market that has historically low valuations, averaging below 15 times earnings. In Europe, a massive overweight favorite at the beginning of the year, a good majority of the investment banks were recommending it, but there are some hints of exhaustion in these markets with some monthly indecision bars printing. If we drop down to the weekly performances, the profile looks vastly different. One, it shows that the strong performance was mostly in the first half of the month, and two, last week's weekly candles generally paint a bearish reversal and markets starting the new month on shakier ground. We can also observe a shaky picture in US equities too. The respective equal weights to the S&P and the Nasdaq is down more than the main cap weighted indices. The US Mag 7 on the whole showing indecision, though there are some strong performers in Apple and Google. And sector performances is generally showing weaker risk appetite. For instance, the cyclical sectors XLY, consumer discretionary, XLI, industrials are down with bearish looking reversal bars. And XLE energy is continuing to put in a strong rebound. And quite often when you have energy rebounding along with oil prices, it usually doesn't bode well for other risk assets due to a higher cost base, its impact on inflation, and so on. Looking at the Fed interest rate probabilities implied by Fed fund futures, markets are almost fully expecting a 25 basis point cut at the September meeting, and another 25 basis points after that before year end, and then another 3 cuts next year. And at this current juncture, you'd have to say that the market expectations is as dovish as it can reasonably get. Looking at macro regimes, now this indicator attempts to map out the different regimes across the economic cycle as indicated by movements in the yield curve, in this case the 2-year versus the 10-year. And it's useful in identifying shorter-term regime shifts and how we can strategically think about markets, prepare, or even position for them. As we can see here, we've been in a bull flattening regime at the beginning of last month, turning predominantly into a bull steepening regime. Looking at this table, we can see that this usually occurs at the end of the cycle when growth starts to slow, inflation follows it lower, and therefore some policy easing to be expected. Though it's been rather noisy with various geopolitical issues, we've seen that economic data has been turning softer, and we've seen inflation continuing to fall, and that's why we've seen stronger expectations for rate cuts. But what often follows is a transition into bear steepening as growth and inflation get stronger, then a bear flattening when a policy response is expected to counter stronger growth and inflation, and a potential overheating perhaps. In fact, these bear regimes is what I think we could potentially see in the months ahead. To briefly cover how assets tend to trade under each of those regimes, this table here shows index currency performances under each regime, backtested since 2004. We can see that the dollar tends to go weaker as the Fed is expected to loosen policy, and then strengthens when the Fed is expected to tighten. And this largely explains why we've seen a big drag on the dollar. Right? If you've observed the price action in DXY over recent months, you will have noticed that it's been carving out a basing pattern as well as some attempts to break out from that base on numerous occasions, but each time it just ends up selling off. So based on this, for the dollar to sustain any bullish breakouts, we'd need to see a transition into these bear regimes where we see rates start to rebound higher. For stocks, they tend to perform best towards the end of the cycle when rate cuts start to be expected by the market, and performs the weakest when the Fed starts to hike. Applying that to our current bull steepening regime, we can see that it's been supportive for stocks, seeing every single dip being lapped up, continuous extensions of all-time highs, and of course we've also had a very strong earnings season playing a part too. For example, we saw a positive surge in sales revisions breadth, meaning that a very large majority of sales forecasts for US companies were revised higher, and basically signaled that corporate America looks to be in fine shape. Here we have the economic surprise indices for the US, Europe, China, and then the more regional ones on the right. US data has been very strong relative to expectations in recent months, showing a 2.5 standard deviation move over the last 2 months or so. Meanwhile, Europe has kind of lost momentum, China has turned negative, and the global fixed weight, the G10 fixed weight, and the emerging market indices have all been in a slump last month, and more broadly over the last 3 months. Looking at this, you might even say that US exceptionalism is back. And we can also see that US economic growth expectations is getting stronger. Last week, we had the second estimate for Q2 real GDP, which came in at 3.3%, and the Fed's latest estimate for Q3 is now running at an annualized rate of 3.5%. Granted, there are some technicalities propping up these GDP figures, like US imports decreasing, which means all else equal, the net exports component in GDP would get a lift, but consumer spending did contribute its fair share to the strong GDP numbers also. So while growth is strong, inflation is also reaccelerating, and we'll have to see whether that trend continues in just over a week's time. But it makes little sense to me that the Fed should be rushing into cuts as inflation is starting to rebound. Meanwhile, financial conditions are getting progressively easier, with our current GDP numbers and inflation ticking back up, and perhaps a labor market that isn't as weak as the headline figures would suggest, that it reflects structural changes in the labor market more than it does actual weakness, it begs to question if financial conditions is too easy and needs tightening up a bit. I also want to add to the point about the labor market that we've seen PMIs point to higher employment activity, and also the NFIB Small Business Survey has been showing increased hiring as well as increased hiring intentions. Looking at what vol markets are pricing in, it's showing about a 0.8 to about 0.85% expected move on the big event days, which is about 13% annualized volatility, and about 0.6% expected move on the other days, which would be about 10% annualized vol. That's quite low. FX vols are also quite muted, looking at the Euro USD vols here, the 2-week and the 1 month in the top panel, which is fairly flat. And then we see the skew in the bottom panel, which is the 2-week and 1 month risk reversals for Euro USD, and it's showing that the options market for Euro USD is currently leaning marginally bullish. To sum up, market expectations is extremely dovish given the circumstances. Economic growth is proving robust, inflation is reaccelerating, financial conditions is getting progressively looser, and vols are looking underpriced considering that we have a few big data points that have the potential to turn market expectations right on its head. For instance, I could easily see a scenario that sees a massive swing from a cut at the end of the month as well as another cut after that being fully expected to a no cut in September or even at all till year end type of scenario. Such a swing would see us transition into these bear regimes where, as we saw earlier, stock market returns tend to go weak and the dollar starts to find some strength. For that, we'll need to see both a strong jobs report as well as inflation to see those regime shifts. At this current juncture, I think those are good bets to make with limited downside and massive potential for upside on those bets. Hope you found that interesting and insightful. If you did, make sure to like the video and subscribe so you don't miss future content. If you're interested in this indicator or any of the others that we develop, check out the link to our group in the video description. And also, If you're a serious trader with an edge and you want to be part of a macro-focused community of professional traders, I think you'll definitely want to take a look at that link too. Thanks for watching, and good luck trading.